Hello, friends. Tim here from Inside Hawk. It is not uncommon when talking to business owners to see that they are reluctant and unsure when it comes to handling their business accounting. They tend to see it as a chore, something that's boring, tedious, and requires expertise to do, let alone to understand. But I'm going to let you in on a little secret. Accounting is actually quite straightforward. Furthermore, understanding it allows you to gain insight into your business and gives you the power to make smart financial decisions. Now, don't get me wrong, financial accounting can get quite complicated. That's why accountants and bookkeepers exist, and I respect that. But the rules and principles underlying these complications remain simple and basic. In fact, it is a lot like chess. While it does take years to master the game, and the arising positions can make your head spin, learning how to move each piece, how to capture, how to castle, and so on, can be done in a matter of minutes. That is the point of this video, giving you the knowledge and confidence to understand basic accounting principles without getting bogged down in unnecessary details. Let's begin.
Everything starts from the accounting equation. Assets equals liabilities plus equity. Let's break this down. What are assets? Now, assets can be thought of as the things that your business is made out of. They can almost be thought of as physical things, although not every asset is physical in nature. So it can be the cash that you have on hand, it can be the summation of all of your bank accounts, it can be the money that is owed to you, otherwise known as accounts receivable, equipment that is part of your business operations, or your inventory if you are a retailer. Now, assets either belong to you, the business owner, or they don't. And liabilities are the portion of assets that do not belong to you, the business owner, but actually belong to other people and third parties. An example of this would be a $5,000 worth in cash that you got by borrowing it from a lender. Now, in this case, the $5,000 asset is actually a $5,000 liability because the lender has the right on this asset. Equity, on the other hand, is the portion of assets that does belong to the business owner. And if we take the same example as before, a $5,000 worth in cash, but this time you got it from your own personal savings account, well, in this case, the $5,000 asset is actually part of your own equity in the business. Pretty easy so far, right? But how do we formalize this? How do we introduce a system that can enforce this sort of equation in real life when we do our books and in accounting software? This is where we introduce double entry accounting, or the system of debits and credits. Now, what are debits and credits? Well, they're simply an abstraction designed to designate the two sides or directions of the accounting equation. Now, before we look at the accounting equation, consider a $100 transaction. What is a transaction? Well, it is simply the flow of money or value from one place to another in your business. It can be, for instance, you buying something for $100, you selling something for $100, or maybe you broke something that you value at $100 and you need to take that value away from the business. In general terms, it is just any flow from one place to another of money or value. Now, whenever you have a transaction in your business, it always has to give rise to the same amount of debits and credits. Always, all the time. That is a hard rule that has to be followed in order for the accounting equation to be enforced. We need to assign a debit side and a credit side to our accounting equation. We're going to say that the assets are the debit side of the equation. In other words, assets will be a class with a debit balance. Debit balance simply means that our assets will increase when we assign debits to them, and they will decrease when we assign credits to them. On the other hand, liabilities and equity will have a credit balance, meaning that they will increase when we assign credits to them and decrease when we assign debits to them. With this, our accounting equation can be reformulated to say that the debit balance must always be equal to the credit balance. Let's take a look at our example of the $100 transaction, which gives rise to 100 debits and 100 credits. What happens when we assign the 100 debits to our assets, and we also assign 100 credits to our assets as well? Well, the 100 debits will be a positive contribution to assets because assets have a debit balance. And the 100 credits will have a negative contribution because, again, assets have a debit balance and we're assigning credits to them. And the liabilities and equity remain unchanged. And therefore, our accounting equation in this case will be 100 minus 100 equals 0. Let's switch things around slightly. As before, we'll assign the 100 debits to our assets, but this time we will assign the 100 credits to our liabilities. As before, the debits will be a positive for assets, and the credits this time will also be a positive for liabilities because liabilities have a credit balance and equity remains unchanged. And in this case, our accounting equation becomes 100 equals 100. Finally, let's assign the credits to our liabilities as in the last example, but this time let's switch the debits from assets to equity. What happens now? Well, as before, our credits are a net positive for our liabilities, but the debits that are now assigned to equity, a credit balance class, will be a negative contribution. And so in this case, our accounting equation is 0 equals 100 minus 100. Now this is great, but it is still quite theoretical, and I want to introduce the concept of accounts to make this concept more practical. I like to think of accounts as objects that have debits and credits attached to them. Just like assets, liabilities, and equity, each account must also have a debit or a credit balance. An account with a debit balance increases when we assign debits to it and decreases when we assign credits to it, and vice versa if an account has a credit balance. And each account must be placed under exactly one class, either assets, liabilities, or equity. Now, what happens when we put a debit account under assets? Well, the balance of this debit account will increase our assets. And some classic examples of this can be your cash on hand, your bank account, your inventory, your accounts receivable. These are all examples of debit accounts that are going to be placed under your assets. They will increase your assets. On the other hand, a credit account that is placed under assets will decrease the total value of assets because, of course, assets has a debit balance and a credit account has a credit balance. In practice, this is a lot more rare, but an example of this would be accumulated depreciation. When you have a long-term asset, such as a vehicle or a building, that loses value over time, this will be represented as a credit account placed in the assets class. Continuing this discussion, placing a credit account under liabilities, which have a credit balance, will, of course, increase the total value of your liabilities. And examples of this would be your loans, your credit card, your leases, your accounts payable, etc. Now, what about debit accounts under liabilities? Well, such accounts would, of course, decrease the total value of your liabilities because they have a debit balance and liabilities have a credit balance. However, in practice, well, there are no real examples of this because we don't really use that too much. You can imagine some weird case where you have an overpaid loan, for example, and you might want to use a debit account under liabilities to illustrate that. But for our intents and purposes, we can ignore that and say that there are no examples of this. But it is important to note that theoretically, there's nothing wrong with placing a debit account under liabilities, as the accounting equation will still be respected. Moving on to equity, this is probably the most interesting case of all, because under equity, both credit accounts and debit accounts have a very important significance. Let's first look at credit accounts under equity, which will of course increase the equity balance because equity has a credit balance. And a very important example of this would be your sales revenue. Anytime you sell something, this increases your equity. And so any type of sales or revenue account must always be a credit account under equity. Another example would be retained earnings. In other words, the part of the profit that is retained or reinvested into the business. Finally, your debit accounts under equity, or accounts under equity whose balance decreases your equity, are also very important, and critical examples of this would be your expenses, your dividends, otherwise known as the part of the profit that is paid back to the investor, or your sale discounts. This video is not meant to be an exhaustive list of all of the accounting conventions that are used in practice, but it is to illustrate the mechanisms behind the accounting equation and the double entry accounting principle. Now, let's take a look at a practical example where we will see everything that we've learned so far.
As before, we will use our $100 transaction, which generates 100 debits and 100 credits. We have our accounting equation, and underneath, you notice I added a cash account and an inventory account under assets, and they're both debit accounts. Let's assign the 100 credits to our cash, and this will decrease the cash balance to minus 100. And our inventory will be assigned the 100 debits, and this will increase our inventory balance to plus 100. And our accounting equation will be minus 100 plus 100 equals 0. And we will interpret this transaction as I just purchased $100 worth of inventory using my cash. And this is how you would record such a transaction in your books. Now, let's make it slightly more interesting. As in the last example, we have a cash debit account under assets. But now, instead of an inventory account, we will add a gas expense account under equity. And a gas expense is a debit account. Now notice we have a debit account on the right side of the equation, which has a credit balance. And we will assign the 100 credits to our cash, which will decrease its balance, as in the last example. And we will assign the 100 debits to our gas expense, which will increase its balance. So our gas expenses are increased by 100. Now what about our accounting equation? Well, on the left side, we have minus 100. Liabilities have no impact. And now with equity, even though we have a positive balance of the account, because the account is a debit account and it's on the right side of the equation, we have to flip the sign to a minus because it has a negative contribution to the credit side of the equation. And so our accounting equation will be minus 100 equals minus 100. And the interpretation of this transaction will be, I just spent $100 in cash on gas, which is an expense for my business. There are many more transaction types that we could cover, and we will in future videos. But for now, what I want you to take away is that your accounts either have a debit balance or a credit balance. And you can put those accounts under assets, liabilities, or equity. And you can assign to those accounts debits or credits. And as long as those debits and credits are of the same amount, your accounting equation will always balance out. Let's do a quick summary of what we've seen so far. First of all, the accounting equation. Assets equals liabilities plus equity. Then we introduced the concept of double entry accounting, which reformulates the accounting equation to say that the debit balance must equal to the credit balance. Then we introduced accounts, and we said that each account must have either a debit or a credit balance. And finally, we said that the accounts can be placed on either side of the accounting equation. And believe it or not, that's it. This is all the theory you need to understand accounting. Every other accounting concept is either a convention or can be derived and understood from these basic principles. I hope this video was useful. Like, comment, share, and subscribe if you enjoyed the presentation. Thank you so much for watching, and have yourself a great day.